In this learning objective, we'll evaluate the acceptability of an investment project using the net present value method. The net present value method compares the present value of cash outflows with the present value of cash inflows. So our steps are calculate the present value of outflows, calculate the present value of inflows, and then simply take the difference between the two. And the difference between the two is referred to as the project's net present value, sometimes abbreviated NPV. In evaluating investment decisions, our net present value rule is quite simple. If the present value of cash inflows is greater than the present value of cash outflows, then the NPV will be positive, and we should accept the project because it will provide a return greater than our required rate of return. If, however, the net present value is negative, that is, the present value of cash outflows is greater than the present value of cash inflows, then the net present value is negative and we will reject the project because its promised return is less than our required rate of return. If a project has a net present value of 0, we will accept the project because the project's return exactly equals our required rate of return. A company's required rate of return is also often referred to as its cost of capital. When we want to acquire an asset, we're going to need to fund it with some sort of liabilities and/or equity. And our cost of capital is the average rate of return that the company must pay to its long-term creditors, debt holders, and the return that stockholders expect for the use of their capital. Our required rate of return, cost of capital, discount rate, those are all terms used synonymously. It serves as the screening device or screening hurdle rate in our net present value analysis. An important point to remember when we're performing our net present value analysis is that we want to focus on cash flows and not accounting net income. The reason for this was accounting net income is based on accrual basis accounting rules. For instance, if we make a sale on credit, we will report a revenue which generates income, but not necessarily cash flow. We don't have cash until we actually collect the accounts receivable. On the expense side of things, we could purchase inventory and spend cash, but until we actually sell that inventory and match that cost with the revenues it's generated, we won't record an expense. Another example would be depreciation expense. It reduces net income, but does not involve a cash outflow. In fact, typically the cash outflow associated with depreciation expense or the purchase of equipment happens at the beginning of a project. Typical cash outflows for capital budgeting projects involve repair and maintenance costs, or perhaps additional incremental operating costs. They will include the initial investment, the purchase price of our equipment, and they also involve working capital. Recall that working capital is defined as the difference between our current assets and our current liabilities. Typically, the initial investment in working capital is a cash outflow for items such as inventory. We're going to build up our inventories when we start our project. We'll make sales on credit, so we'll have a build up or an increase in accounts receivable. And typically, we will assume that we will recover all of that working capital. It will be a cash inflow when the project is over. We will sell off our inventories, we will collect our accounts receivable, so our current assets will decrease and we will have a cash inflow. So again, typically on our projects, we'll assume we have a cash outflow for working capital at the start of a project and an equal cash inflow of working capital at the end of the project. Examples of typical cash inflows include, again, the release of working capital that we just discussed. We might have a salvage value for the selling of our equipment at the end of the project when we no longer need it. The equipment might generate additional incremental revenues or cash coming in inflows on an annual basis, or it might reduce our costs. There are a couple simplifying assumptions that we usually make in performing net present value analysis. We need to put them out there. They're nothing you need to focus on too intently. The first is that we typically assume all cash inflows, other than the initial investment, occur at the end of the period. So in other words, any cash inflows or outflows we will assume occur at the end of each year. We could assume that they occur throughout the year or at the beginning of the year, but to simplify things, our assumption is the cash inflows and outflows will occur at the end of each period, again, with the exception of our initial investment. A second assumption that we make is that all cash flows that are generated by our investment project are immediately reinvested at a rate equal to our required rate of return or our discount rate. There's nothing you need to do with this assumption. It's just something that finance professors in particular like to talk about when we discuss net present value analysis. Let's go ahead now and look at how we would use the net present value method to make or evaluate an investment decision. Let's assume the Franklin Company is considering purchasing a $30,000 machine that would reduce its operating cost by $8,000 a year for 6 years. If Franklin has a 12% cost of capital, what's the investment's net present value? And in doing this analysis, we're going to ignore income taxes. Let's begin by looking at the initial investment or purchase of equipment. That's a cash flow that's occurring now, and it was a cash outflow of $30,000. So the present value of that is the same $30,000. Next, let's consider the annual savings that we said were going to be $8,000 a year for 6 years. We'll take that $8,000 and multiply it by the present value annuity factor for 6 years and 12%. And that factor, if we looked it up in our table, is 4.111. So the present value of receiving $8,000 a year for 6 years at a 12% interest rate is $32,888. Finally, we need to concern the salvage value. The salvage value of our equipment was $1,000, and since that's going to be received in year 6, we need to find the present value of $1 for 6 years at 12%. And again, this is a lump sum rather than an annuity. So we'll look it up in our table 1, 12.1, and we get a factor of 0.507. This means the present value of that $1,000 that we'll receive at the end of year 6. Today, that's only worth $507. So finally, we'll add up the present value of all of our cash outflows and cash inflows, and we see that the project has a positive net present value of $3,395. And because the net present value is positive, we will accept the project. Let's consider another example, somewhat more complex. The Lester Company has been offered a 5-year contract to provide component parts for a large manufacturer. And here's a breakdown of our cost and revenues. To undertake or to accept this contract, we're going to have to purchase some special equipment at a cost of $160,000 today, and we're going to need to invest $100,000 in working capital. Also, our equipment is going to require some relining or maintenance cost of $30,000 in year 3. And at the end of the 5-year project, we expect to be able to sell the equipment for $5,000. In terms of annual cash revenues and costs, and again, notice instead of saying annual revenues and cost, which would be net income, they're stretching things and just saying that they are actual cash revenues and cost. That gets away from that problem that we're talking about cash flows and not net income. In Chapter 13, we'll look at cash flow statements. We're told that we have cash revenues from sales of $750,000 a year, and our costs of $400,000 a year, and then we also have some salaries and shipping of $270,000 a year. Finally, we're told at the end of 5 years that working capital will be released. In other words, we'll get that $100,000 back, and that we have a cost of capital or discount rate or required rate of return of 10%. Let's go ahead and look at whether or not we should accept the contract. First, let's consider or calculate the annual net cash inflows from this project. It was going to generate $750,000 in cash revenues, and we had costs of $670,000 in total. So the annual cash inflows from this project will be $80,000 a year for 5 years. Let's go ahead now and look at our cash flows. Again, the project was going to require an investment in the equipment of $160,000 today at time 0, an investment in working capital today time zero again of $100,000. So the present value of each of these, since they're happening today, is the nominal amount itself of $160,000 and $100,000. Next, let's consider the annual cash inflows that were going to occur over years 1 through 5. That was $80,000 a year. We need to look up the present value of an annuity factor for $1 for 5 years at 10% interest. And if we look that up in the table, we find that that factor is 3.791. So we multiply the 3.791 by our $80,000 a year cash flow, and we find that annuity has a present value of $303,280. Next, let's go ahead and consider the cash outflow for relining or doing the maintenance on the equipment. That was going to be a $30,000 cash outflow in year 3. So we need to multiply that by the present value factor for 3 years at 10% of a $1 lump sum. Notice it's not an annuity factor, it's the present value of single amount. And that factor, 0.751 times 30,000, gives us a present value of that cash outflow of negative $22,530. Finally, we had salvage value and the release of working capital at the end of our project's life. And again, those are both additionally just lump sum amounts. So the present value factor, 5 years at 10%, is 0.621. We multiply that by the 5,000 and get present value of our salvage is 3,105. The present value of the release of the working capital is 62,100. Finally, when we add together all of our present values of our cash inflows and our cash outflows, we find a positive net present value of $85,955. So this is a good project, and we should accept the contract because it has a positive net present value. It'll provide a return greater than our required return of 10%.